Hello and welcome to Bazaar Morning Call. I'm Prashant, with me my colleagues Sonia and Nigel. As always, guys, hi, good morning.
Good morning.
Waking up to slightly more modest and tepid kind of cues, right? And I think the thing to blame is the US Treasury market. So we got blowout moves in the US Treasury market, both across the curve actually. The 2-year, the 5-year, the 10-year, the 30-year all moved up very strongly. 13 basis points in 5-year, 10, 12 basis points. 30-year tenor moved up 9 basis points as well, all comfortably above the 4% mark. The 2-year actually at almost 4.5%. It actually crossed 4.5%, and people are already pegging 5%, just under 5% kind of levels. No real singular trigger for this. We'll come to that in just a bit. But that is putting a lot of pressure on the dollar upwards and consequently on other forex lower. As the dollar moves higher, pairs against its trades actively, that goes lower. You saw that yesterday in the dollar rupee, that big move, 83.02 at close. In offshore markets, I think there is a little bit more pressure, so we'll see that this morning. And we'll talk more about this. Stability in the dollar rupee is key. You don't want sharp depreciation. Yesterday is one of the sharpest we've seen. Just about almost all of that fall came in just 40 odd minutes of trade. So that was pretty large. And pretty spectacular. So we want stability there, and I think equities will watch that very closely as well. SGX is indicating a lower start by about 120 odd points or so. Guys, hi, good morning.
Hi, Prashant. Morning. Nigel, morning. And I think that was a big talking point yesterday, right? The fall in the rupee. And I think the Nifty came off about 100 points from the highs in late trade because of the kind of sell-off that we saw in the rupee. So that's going to be tracked very closely. But don't forget, the Nifty is still just 6% away from that 52-week high. So the market is still in fine fettle, although purely for today, the SGX Nifty is down about 140 odd points. A couple of things, we'll discuss more about the rupee, of course, but there was that one foreign bank that saw a large amount of dollar buying, and whether that was just a freak move or not, only time will tell. But for today, the expectation is perhaps that weakness could continue. For the Nifty, it held on to that 17,500 mark yesterday, and FI selling has been on a reducing trajectory, which is good for the bulls. Yesterday as well, FI sold just about 450 odd crores. It was more than compensated by buying from the domestic fraternity. And over the last many days, the selling has been less than 500 crores in the last 3 trading sessions. So that's a good thing. On Wall Street as well, there was a 2-day rally and that got halted. Minor losses, nothing alarming, about 100 points lower on the Dow. But the rupee is something that we're all going to track very closely today as well. Yes, there is weakness, but the ramifications that would have on equity markets is something that will be watched.
You want rupee to be stable, not fast depreciating, and expectations are important, right? I mean, if you're a foreign investor and think that the rupee is going to be sharply lower 6 months down the line, I mean, you're better off locking in profits now, right? And that is the spiral you don't want. In any case, I mean, just like equity markets, the rupee has also been the outperformer, standout outperformer amongst large economies. So let there be no doubt about that. What happened yesterday? Will the RBI come in today to defend, to douse the fire if there is another pressure once again this morning? We don't know, and those questions one cannot answer. But I think it's also important to look at what's happening in the dollar rupee in the global context. And I'll just use this as an example, use what's happening in the Chinese yuan as an example. The basic driver, the basic dynamic at play is this: yields move up, leads to dollar strength and pressure across other foreign exchange markets. So what's happening? The Chinese yuan, for example, hit a new low yesterday. The dollar yuan hit a new high. The dollar against the yuan hit a new high yesterday. A sustained sell-off in the yuan is a sign of concern for global macro outlook. I'll tell you why. China is one of the largest exporters, right? Even after the slowdown, etc. What a very weak Chinese yuan does is basically it puts pressure on other economies, other central banks. Even, for example, for that matter, India, we compete against China, in exports market, and currency is a big part of it. You need a weaker currency for export competitiveness. It kind of puts pressure for devaluation in other major exporters as they seek to retain competitiveness. This is just one dynamic I'm pointing out. But what that does is, because you've got inflation which is high, weaker currency basically is importing inflation for a large importer like India. So, to retain export competitiveness, you want a weaker currency, but to control inflation, you want a stronger currency. I mean, what I'm trying to say is that this forex flux and what's happening largely to the US dollar, I mean, that is complicating the policy outlook for a lot of economies around the world. And this dynamic is something which bears very close watching. For today, you want a little bit of stability this morning and nothing like what we saw yesterday. I don't think we'll see something like what happened yesterday. It doesn't happen every day. Even yesterday was, I would say, very, very rare. All right, on the markets, the Nifty here, the Nifty and the Bank Nifty, I'll just quickly run through levels. So we closed under 17,581, which is the 61.8% retracement of the fall. We closed under that level, and this morning we'll start below it once again. It's unlikely that we'll close above 17,581, but if we manage to at some point in the day, the next level to watch is 17,680, which is nothing but the upper end of the rising channel from the lows of September. But I think today what is more relevant is supports. The supports come in around 17,200 and 17,300. One is the 40-day exponential moving average. The other is the simple 20-day moving average. So this is the zone for the support. I think you'll start slightly maybe above these levels, around 17,350 or so. On the Bank Nifty, which is the stronger of the two, and it's continued to move higher in a much faster pace. The upper end of the rising channel for the Bank Nifty is 40,800. And beyond that, you've got levels like 40,900, which is the 78.6% retracement of the entire fall. For the Bank Nifty as well, I think what you want to watch are lows that, the Bank Nifty bounced off from last week. And I think that those should act as good supports as well. It's going to be a lower start, but I think, it bears watching, especially because of what's happening in the currency. If everything else remaining same, the same dynamic of the market here falling less as compared to global markets on negative days may come back into play. So it may not be a bad idea to watch the space, get some stability in, and trying small long positions here once again. Nigel, hi.
Well, we got a global challenge, right, today, because Brent crude prices are a little bit higher than what we woke up to yesterday. You have the US 10-year that's moved to around 4.1%, which is the highest we've seen since 2008. And also the dollar index, well, late last year, in trade for us itself, it moved to around 112.8. It's closer to around 139. So we have a global challenge on our hands. The biggest trigger will be the rupee. Some stability out there is something that we're going to be looking forward to, because yesterday, clearly, with it slipping, it soured sentiment. And that's why the Nifty did come off the high point. Now, we ended high yesterday, mildly so. The India VIX, though, that has well moved up marginally. I'll keep an eye on the India VIX because you'd like that to cool down. And that's been the case for the last few days. But yesterday, it was a little bit higher. Institutional flows are good. The DI buying has offset the FI selling. So yesterday, the DI is bought twice of what the FI sold. And that's why you had a net institution buy number of close to 450 crores. The FI data, though, in the F&O market, well, that's a little bit cautious. After a couple of days of short covering, yesterday they added shorts yet again, close to 4,000 contracts on the short side. In the ratio of 2:1, remember, they continue to remain net short with the positioning at around 70% short. They wrote calls. For me, that's a bit of a worry. After a while, we're seeing call writing, and it was quite aggressive. Close to around 70,000 contracts is what they wrote on the call side. That, again, in the ratio of 2:1. And in case things go wrong, well, they have been buying puts. But that's a smaller data point. The call writing is a bit of a worry, particularly when we're getting into weekly expiry, which is today. On the Nifty and the Nifty Bank, I just want to pull out two strikes. Yesterday, we made a high at around that 17,600 odd mark. The 17,600 call, it has the highest open interest. The premium out there is around 23 rupees. So for all practical purposes, 17,630, that is unlikely to get breached, at least since we have weekly expiry today. And yesterday, it added more than 30 lakh shares. On the Nifty Bank as well, we went to around 40,600 and we did a bit of a U-turn from there. The 40,500 call has the highest open interest out there. Premium around 124. So you plug it in, 40,500 plus around 150, that's giving you a bit of a resistance. What are the levels you're looking at on the Nifty? Well, resistance zone 17,600, 17,650. A bigger effort will be needed to get us past that. On the downside, though, 17,350, that base seems to be moved up a little bit. So I'm counting on that level. Holding out, for starters, SGX Nifty is indicating a bit of a pullback closer to around that support zone. So
okay, and the band has gotten a bit more tighter, right?
Yes.
I mean, the range has gotten narrower. But we'll also be watching out for a lot of earnings today. It's a hectic day on the earnings calendar. There's ITC that comes out with numbers, and remember, ITC has been one of the strongest stocks this year. It's up about 56 or 60% this year. Expected to be a very strong showing this time around as well. Good cigarette volumes. And other companies, there's Asian Paints, there's Axis Bank, there's Tata Consumer, and a lot from the NBFC space as well. But I'm watching out for Reliance Industries very closely tomorrow. because Reliance, although the stock has gone up about 6% in the last few days, the numbers are going to be weak. So there's a sharp weakness in the oil to chemical business. It will get compensated by an improvement in retail, in its retail businesses. But do keep an eye out on Reliance. There's HUL tomorrow as well. And on Saturday, we wrap it up with ICICI Bank and Kotak Mahindra Bank. So the next 3 days are very earnings heavy, especially as far as the Nifty constituents are concerned, and would be an important sentiment indicator for the market. But let's kickstart the show. Today is going to be a day of red. At least the start will be like that. Let's see if the dips get bought or not. On the equities front, we have a comment coming in from Amit Sachdeva of HDFC, who says that rising US bond yields and recession fears in the US and Europe are likely to cause volatility in the Indian market, but India has its own positives. According to him, the factors lending support are growth resilience, a weak base of FI flows, and prospects of commodity easing. They see favorable risk-reward and opportunities during this time of uncertainty when long-term appeal for India is on the rise. Key ideas include private banks, the likes of ICICI, HDFC Bank, Axis Bank, retailers like D-Mart, Titan, Nykaa, and from the consumer discretionary space, they like Maruti, Zomato, Crompton, PVR. They are also positive on select IT stocks post the correction, which include Infosys, L&T, Infotech and Ultratech, UPL, Polycab and Apollo Hospital. So very interesting list of stocks, both large as well as mid caps that they like.
Well, there are plenty of stocks, Sonia, that we'll be tracking for our audience today, and we'll get to that in just in a bit in our top 10 segment. We're looking at IndusInd Bank, AU Small Finance Bank, Home First Finance, Persistent Systems, Metro Brands, Max Financial Services, as well as Shoppers Stop. They are stocks that are on our radar on the back of positive news flow, while Havells, Lupin and Navin Fluorine, they are stocks that are likely to open up in the red.
All right, let's get a global opinion, and a big one at that, right on the top of the program. Christy Fong is Senior Investment Director at Asian Equities at Aberdeen, and she's joining us right now to take some questions. Christy, great to have you with us here on the program. Thanks very much for your time. So just a view on, I mean, you guys are big emerging market investors, Asian emerging market investors, big investor here in India as well. So let me just straight off the bat ask you about what is your view on India, prospects from here out for the next 6 to 12 months?
Hi, good morning. I just wanted to say it's a pleasure to be here ahead of the festive season, Diwali. So happy Diwali to all of you in advance. We've always liked India. India has always been an attractive market for us. We are long-term quality investors, and because of that, you know, there are a lot of companies listed in India that tick many boxes for us. So attractive market, you know, very good long-term prospects. Obviously not without its challenges in the past, but we've seen how companies have been tested through cycles, showing resilience, you know, great management teams. So yeah, very positive on India at the moment.
Okay, very positive on India. Christy, good morning and greetings of the season to you from our entire team at CNBC-TV18. It's a pleasure to have you on the channel. Although India is in a good place, the global markets don't seem to be. And there are, of course, many more rate hikes coming through as well. Inflation is still not under control in the US. How do you think the setup looks as we head into a new calendar year? Would you be cautious on equities overall? And what should the investment strategy be?
Yeah, I mean, it's not easy times for markets, many asset classes, equities particularly. Like you said, a lot of things to worry about, whether it's rates going up, inflation, tightening stance by monetary policies, and I guess geopolitical risk as well. So obviously the likelihood of, you know, recessions or slowdown, that's quite clear. So, you know, it's not easy. Macro outlook's getting cloudier, but at the same time, you are seeing that reflected in prices and valuations as well. So I guess it depends on one's patience, you know, your investment time horizon, and I suppose picking the right stock ultimately, buying a company that can do better than peers, you know, in such difficult times, because when things are easy, you know, everyone does well, but I think this is really when a company gets tested.
Hi, Christy. Morning. Nigel on this side. Christy, you know, you said that India definitely deserves a higher amount of flows. I mean, you're fairly positive on India. Where does it feature in the pecking order? If you compare us, not with just the emerging markets, we've even been outperforming the mother market. So if you could give us a sense on that. And since you're positive on India, what's the top sector you're bullish on?
Okay. So India has been and continues to be an overweight for us. It's a market that we like, not just compared to other emerging markets, but also developed markets as well within Asia. So it is favored for us. Obviously, it's in a relatively better place given all that's happening elsewhere in the region. So India's amongst our preferred markets. Within that, we've always liked the domestic consumption story. That has not changed. We continue to like the private sector banks. Banks, has been through a difficult cycle, especially in the last 2-3 years. And you are seeing that starting to turn around. So we are constructive on banks, especially the private sector financials. Consumer names is another one that we favor, and that comes in different forms. So it comes through in not just staples, discretionaries, but communication services. So that's the underlying driver that we like and we see attractive in India.
And we have some of your top holdings here and sort of on the screen for our viewers. And we'll come to some of these in just a bit. Christy, I just want to, since you are not just an India investor, but a regional investor as well, right? Asian and emerging markets, etc. I have two questions. One, when you get redemptions, and most global funds are because it's a tough environment, how do you decide where to, because that's been a big debate. Why are FIIs or foreign investors sellers in India? Is it because they're getting redemptions elsewhere? Is it because valuations are too rich? So that is one question. And second, I don't know if you saw this Bank of America fund managers survey. It was about their intentions in the next 12 to 14 months in terms of which emerging market they most like and which they kind of did not like very much. China was top of the list in terms of what they would want to buy, maybe because it's so cheap now. India was actually on the other side. And these are intentions, not their actual positioning. So yeah, both those points, Christy, go on.
Okay. I guess, markets are funny that way. And we can talk about fundamentals, but it's very much to do with expectations as well. And markets move along with where expectations undershoot or overshoot. And it's also a relative call. So yes, India looks attractive, but if you're managing a regional portfolio, think about the other areas that could give you a bit more alpha, if you can use that term. So I think in terms of, you're right, there's been flows out of equities, and it's always easier to take profits where there's profits to be taken. India does look relatively more expensive, although for us, when we look at it from a longer term horizon, 3 to 5 years, yes, you are seeing slowing growth everywhere. India might be exposed to that slowdown as well, but it is still better growth and better returns compared to other countries. So we will still keep a structural overweight there, but I guess some of these flows could be driven by technical reasons. I'm sorry, I think I might have missed out on your, yes, and China.
Yeah.
So yeah.
The survey, the fund manager survey, but I get
valuations as well. Yeah. So I think at the moment, the struggles or the challenges in China actually makes India look pretty good. I think there's much greater appreciation for what India has to offer in terms of, having a richer or more robust private enterprise. On the regulations front and reform, it's been beneficial or in the right direction at least. So India has looked like a better place to be. But I suppose markets are fickle as well. And if you start seeing that shift, any sentiment is really bad outside India, especially in a market like China. And if that starts to just shift a bit, I guess you could see a bit more rotation happening.
Christy, let's talk about individual sectors, right? Because for the longest time, Aberdeen has been very bullish on the IT space, especially some of the large cap IT names. What do you do here? Are you a contra investor? Would you continue to stay bullish despite the 20-30% fall that large cap IT companies have seen?
Yes, IT companies, we continue to like. We continue to like the ones that we hold. but we're also very mindful of how much in the last couple of years. So I think taking profits is always the right thing to do, or at least it's a healthy way. We do expect volatility in markets, and there's always that could be prone to pullbacks. So we have, while we maintain a liking for IT services, we have been reducing the exposure by taking some profits. But again, it's an area that we feel is in the right place. Demand is still strong. Obviously, the strength of the demand depends on the outlook of the global economy. So again, not discounting the fact that it could be a bit of slowdown, labor tightening, margin pressure, that's also happening as well. So if you're asking about whether we're taking a contrarian view, we're taking a longer term view and will remain constructive on the names that we believe will do better than their competitors.
Okay, so that's on the tech space. Interesting. There's also a consolidation wave in sectors like cement. Is there any structural re-rating on the cards here? And is Aberdeen playing the cement sector in any way?
Yes, we've always liked cement for the fact that we consider it a proxy to housing construction and increasingly in infrastructure investment as well. The industry has been, there are many competitors, but they're quite clear leaders within the industry. So take someone for Ultratech Cement, for example, that has really proven its worth, its scale, its cost efficiency, and how it continues to deliver on good returns over cycles, having the balance sheet to consolidate and make acquisitions. We do like the fact that they also think about ESG issues and thinking about reducing their carbon footprint. Yes, I think there is consolidation, yet at the same time, they're seeing some big competitors coming in as well. So that's also something to watch. I guess the capacity in Indian cement is expected to, the supply-demand situation. I think that is really what's key. So yes, supply could increase, but I think with the demand backdrop being quite healthy as well, that should still make the outlook for cement quite a healthy one.
Okay, Christy, thanks a lot for stopping by and speaking with CNBC-TV18. It was our pleasure to host you on the channel. Well, that's the word coming in from Aberdeen. They say that the global macro outlook is getting cloudier, but they like India for the longer term. Let's slip into a quick break on that note. On the other side, our entire list of top 10 stocks will be with you in moments from now. Don't go anywhere. Well, it's a 100-point knockdown on the SGX Nifty this morning, 130 points to be precise, but plenty of stocks to talk about. Indus and Bank came out with a good set of numbers. Abhishek is here to give us the fine print. Abhishek, over to you.
Well, it's a record quarter for Indus and Bank across many parameters. It's perhaps the only bank to give a continuous 8-quarter in terms of YOY and quarter-on-quarter operating profit growth. The net interest margin is at 9-quarter high of 4.24%. The return ratios, both the ROA and ROE, are perhaps the best in last 11 quarters, with ROA at 1.8% and ROE around 14.5%. So YOY, the loan growth is best in 11 quarters, and quarter-on-quarter, the loan growth is also one of the best in last 2 to 3 years. So NII growth is robust on account of better yield that they have got on their loan book. Slippage ratio is slippages overall are one of the lowest in last 8 quarters and second lowest in last 12 quarters. So gross NPA ratio has come down to 2.11%, perhaps the lowest that you are seeing in last 3.5 years. So both in terms of NII and PAT, they are a beat on our poll. Back to you.
All right, Abhishek, thanks a lot for that. Well, let's hop across to Vahista. Vahista, I would like to hear what the Havells management has to say, but these numbers look disappointing, isn't it?
That's right, Nigel. The numbers are disappointing. It's another weak quarter for Havells India. There was a sharp margin decline with a miss on the CNBC-TV18 poll. The margin estimates were at 10.9%, which is anyways lower than 13.8%, which was clocked in the same quarter of last year. But the actual margins have come in at 7.8%. versus the estimates of 10.9%. The company says that the margins were impacted owing to the full absorption of high-cost inventory against the falling raw material prices in this quarter. But the silver lining, however, is that the margins are expected to improve Q3 of FY23 onwards. Also, the company has mentioned that the consumer demand is sluggish at present. The electrical consumer durables revenues were impacted due to short-term destocking in fans, which was led by changes in energy efficiency norms. Also, Lloyd's contribution has turned negative with EBIT margins dropping to negative 20%. Expect the stock to be in red today.
Okay, thanks for that. So it's a weak quarter for Havels, but let's get back to financials. AU Small Finance Bank and Home First Finance on our radar. Abhishek, how did the numbers look?
Both the numbers were really good, especially on the business momentum. Coming on to AU Small Finance Bank, the net interest margin has expanded by 30 basis points on account of two key reasons. One is that they demanded on yield, which was pretty strong sequentially, and also the fact that CASA ratio jumped up by 346 basis points quarter on quarter, which aided their cost of funds. So AM growth was around 38% YOY and about 4.5% sequentially. Slippages, they remained under control with the annualized slippage ratio of just a little more than 2%. Asset quality has improved and restructured book has also declined to 1.7% versus 2.1% in the previous quarter. Both in terms of NI and PAT, they are a beat on our poll. Home First Finance, the customer acquisition was pretty strong this time around, which aided the overall business momentum. So customer base grew by 5.74% sequentially. The disbursals were up 36% YOY and about more than 6% sequentially. AM growth was pretty robust, growing at 35.9% YOY and about 7.6% quarter on quarter. They have been able to improvise on their net interest margin, which is jumped up to 6.5% when compared to 5.2% on a YOY basis and about 6.4% on a sequential basis. Asset quality has also improved as gross NPA ratio is down about 20-30 basis points on a sequential basis. Back to you.
Thanks a lot for that, Abhishek. We'll get chatting with the management of Home First Finance in just a bit. But for the time being, let's get in Reema to tell us about a mid-cap IT company, Persistent. Reema looked good, eh?
It does. It's a beat on the revenue and margins. Persistent numbers have come in pretty strong. Dollar revenue growth at 5.8%. This has been aided by about 80 to 100 basis points on the back of acquisition. Margin expansion has come in as a surprise. The street was anticipating margins to decline due to the wage hike impact, but margins for the company have increased by 30 basis points, up for the 10th consecutive quarter. Deal wins are slightly lower on a quarter-on-quarter basis, but attrition is sticking lower for the third straight quarter. All in all, it's a good set from Persistent. Back to you.
All right, Reema, thanks very much. Lupin should be in focus as well. Ekta's got more there. Ekta.
Thanks. Well, definitely negative news for Lupin this morning because they've received 17 observations from the US FDA for their biotech manufacturing facility or biotech facility in Pune. So that might weigh on the stock, but they did announce early this morning that they are acquiring 2 inhalation brands for around $75 million in the US market. So maybe that could negate a little bit of pain, but nonetheless, 17 observations is something which is quite stark. And the street is probably not going to like it on an overall basis. So I expect the stock to be in the red, maybe some upside on account of acquisition of those 2 inhalation brands.
Okay, thanks a lot, Ekta, for that. Well, let's find out how Naveen Fluorine did this quarter around. Sonal has the data for us. Sonal, over to you.
Good morning, Sonia. It was a top-down miss as far as Naveen Fluorine is concerned. Yes, revenue growth of 13%, but it was way lower than what the street was working with at 440 crore rupees. EBITDA up 8% and 90 crores versus an estimate of 116 crore rupees. Margins actually fell this quarter to 24.6%. Profits were up just 3%. Well, it is the higher raw material costs which impacted companies' margins this time around, and it is higher depreciation and interest costs which actually impacted the profit growth for the company as well, which was just 3%. Specialty chemicals did well, where revenues grew by 46%. HPP business, where revenues were up 71%, but the CDMO business was really weak, where revenues declined 53% on a YOY basis. The conference call is at 11 a.m., so we'll get more details. But for starters, expect the stock to be in the red today.
All right, thanks very much, Sonal, for that. Metro Brands, Mangalam is standing by with more on that one. Mangalam, hi.
Well, they reported numbers, good numbers year on year, 47% jump in their revenues, 52% jump in their EBITDA and 50% jump in their net profit. And that's primarily because it was a low favorable base. But quarter on quarter, there has been a decline of 6% in their revenues, a 19% cut in their EBITDA. And as a result of which, over the first quarter, we've seen a decline of 27% in their profits. But, you know, the street will like the acquisition that they've made. They've gone ahead and acquired a listed company, Crevatex Brands, for about 202 crores in cash. So to that extent, we'll be watching that stock as well, because because it's a listed company with 98 crore market cap. They import, sell and retail brands Fila as well as Proline. Fila is a strong brand which Metro can actually scale up. Cravotex's last couple of years revenues were between 100 and 150 odd crores, which they got the company for 202 crores. If they can scale it up, you know, the street is something, the street will like the potential of this, and that is something they will watch more than the results this time around, see some green on this acquisition.
Okay, all right. Mangalam, thanks for that. Well, going back to Surbhi, Surbhi, tell us about Max Finance.
Max Life numbers were strong on the margin front but muted on the growth front. Q2 VNB margins came in at an all-time high, up 210 basis points at 31.3%. This was likely because of a favorable product mix. The share of ULIP products was lower this time around. The APE was down 7% sequentially, which was in line with our estimates. Solvency came in at 1.96 versus 2.1 same time last year, so that's a little bit of a concern. But the key thing to watch out for this stock is going to be the management commentary on the progress of the next leg of the Max Axis transaction. So the con call is at 9 a.m. today, so we will keep an eye out for that today. But overall, good numbers from Max Life.
Okay, good numbers from Max Life, but are people shopping more? We definitely think so. One step into Shoppers Stop and perhaps you'll know. Mangalam, tell us, how did it look?
Well, the numbers suggest that people are indeed shopping more, not just in the festive season, but in the season before that as well. 57% jump in their revenues, EBITDA more than doubling, 128% jump out there, and on a low base, the net profit also, you know, or rather the bottom line turned into profit as against a loss of 3.5 odd crores. Quarter on quarter, there's been a jump of almost 7% in the revenues as well, though the EBITDA has not grown as much because of high input inflation. The other internals, they are extremely strong. Footfalls of nearly 4.1 crore people. This compares with pre-COVID levels of nearly 3 crore people. Beauty products selling 45%, their private label selling around 76% higher, and 6 stores will be opened in the third quarter. So these are things that will keep the stock afloat in today's trading session.
Okay, all right, Mangalam, thanks for that. Well, let's do a quick recap then of all the top stocks that we just covered for you. Stocks with positive news flow include IndusInd Bank, AU Small Finance Bank, Home First Finance, Persistent Systems, Metro Brands, Max Financial Services, as well as Shoppers Stop. All stocks with negative news flow include Havells, Lupin, as well as Navin Fluorine.
Okay, that's the list of top 10 stocks. But let's get a quick handle on what's happening in the world of commodities and currencies, because that seems to be dominating mind space. First on commodities, Manisha Gupta joins in for a quick roundup of the action there. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, you know, some pressure could come in from the crude oil prices also, which have gained 4% overnight. So just as we were trying to break below $90 a barrel, we are back above 92 and quite strongly at that. One, you have the U.S. inventories, which have shown a surprise decline. That got the bulls back into the market. And then you have the 27 European Union countries meeting today for the second time in a fortnight. And the countries have an agenda to back an alternative price benchmark for LNG, joint gas buying. Though, of course, Germany and Netherlands have been opposing a cap on Russian gas prices, but the markets, or rather the countries, will also discuss emergency spending to counter effects from energy crunch. This is something that the street will be watching out for. Having said that, the way the currencies are moving, that's another factor. The U.S. Treasury yields at highest levels since 2008 is something that the markets will also keep an eye on.
All right, Manisha, thanks very much for that quick wrap out. Oil and dollar, two external variables, very important for India. As well. I mean, we don't produce much of oil and we don't print dollars, but we need both. Well, on that note, let's also talk about the rupee, right, which made that big move in the last hour of trade and hit 83, but we're just under it. And as we begin today, dollar is on the rise once again. Lata is here in the studio. Lata, tell us more. Two questions. One, what happened? I think people are still scratching their heads. Many are. And second, will the RBI take the other side if there were to be pressure once again today?
Difficult to guess the RBI, but well, you know, yesterday there was a global backdrop also, which towards evening was turning negative EM currencies. The US bond yields were over 4% and they were going towards 4.08, 4.09 as our trading day was ending. The yen going towards 150, yuan going toward the Hong Kong yuan going towards the 7.25 mark. So there was a global backdrop also which was edging us lower, but it appears that there was one foreign bank with a large buy order. And, you know, a couple of people would know about this when they see them buying. So there were stops put at 82.30, 82.50, points where the Reserve Bank has intervened in the previous and protected. So, okay, if this big bank is buying, Reserve Bank would come and supply so that the dollar doesn't rise too much. That didn't happen. So it was more like a poker game between market and RBI, and RBI refused to blink. And, everybody's stops got triggered, including the big bank, which was buying dollars. And probably the central bank wanted to buy them expensive. Why should they be allowed to buy dollars cheap? That's what happened in terms of the last hour fall, which was sudden. But there's no taking away that the vibes are still against the rupee. Today, if anything, the yields are even higher in the US at, 4.15, 4.14 and change. The Asian currencies are opening even lower. The yen, 149.92. I mean, we are at 150. The Hong Kong yuan, again, 7.27. So that's the lowest since 2007, 2008. The backdrop is still a negative rupee. And, now there is also another kind of poker game which the market is playing. The Reserve Bank reserves have come down to now 8 months import cover. Earlier, when it was 640 and imports were smaller, they had 10 months of import cover. Now imports are running at 60 billion a month, and the reserves have fallen for both reasons, RBI selling and depreciation of some currencies. So now the market, will they allow depreciation rather than use reserves? You don't want to come to 6 months. That is a Plimsoll line which RBI won't come to. So there are other reasons why the rupee could fall, but kind of cataclysmic waterfall may not happen. And Q4 is always positive for India. There are very good flows, but Q3 is there before Q4 starts.
Okay, all right, Lata, thanks a lot for that. So that's the big headline, right? The rupee at a record low. Let's watch it very closely today. But let's get back to tracking stocks. We'll take a quick break. On the other side, Gurmeet Chadda of Complete Circle Consultants will join in for some fundamental analysis. We'll also be connecting with Manoj Vishwanathan, who's the MD and CEO of Home First Finance, to discuss their Q2 earnings as well. Stay tuned.
Welcome back. We're bracing for a bit of a down day. S-shaped Nifty is indicating a down tick of close to around 100 and 110 points. Actually, things have improved a little bit, so that's good to see. Well, let's get in Gurmeet Chadda, Managing Partner and CIO at Complete Circle, who joins us. Morning, Gurmeet. Thanks so much for joining in. Well, the SGX Nifty is indicating a bit of a downtick, but one stock that could relatively outperform is IndusInd Bank. Records galore. If you're looking at the 8-quarter high in terms of operating profit, NIMs at multi-quarter highs, as well as return ratios at the best we've seen in 11 quarters. But the stock has seen a good rally from around that 800, 850 odd mark. What's your view on the stock?
Nigel, I think perfect combination results in IndusInd. As you rightly said, the NII went up 18%. Retail advances have been up. I think what I was looking more was the restructured book has also come down from upwards of 2% to 1.5% versus quarter one. And that led to some moderation in credit costs. So when your NIMs expand, your advances are growing well, and if you have lesser provisioning and lesser delinquency, that's a combination you want to look at, which is what, let's say, an ICICI has demonstrated over the last 2-3 years. So I think I'm seeing this ROA of 1.4% and almost 14% ROE after some time now in IndusInd. And I think what would be needed is more consistency now. If they can do this over a few more quarters, because their restructured pool also comprises MFI, commercial loans, SME. So their loan texture is slightly different than some of the large private sector banks. But if they can demonstrate that, and I think MFI growth can come if things remain stable in India, I think then some, maybe I would not say re-rating, maybe getting back to what it used to be originally rated at seems to be a possibility.
Okay. Gurmeet, hi, good morning. Your thoughts on Persistent Systems, strong margins up for the 8th, 9th quarter, and quite resilient compared to a lot of its peers. Would you buy this stock at this price?
So, as I said, some IT companies are getting differentiated. So, again, while we are used to seeing Persistent at 8-9% Q-on-Q growth in CC terms, this one was slightly lesser, but still good. I think they first time have done 1 billion, upwards of 1 billion. They crossed almost, so deal win was pretty good. Also, if you see their dependence on their top account, which is IBM, it's just now down to about 8.5, 8.6%. So there is more granularity there. We're able to maintain margins despite wage hikes and all the supply side pressures we have seen. Also, I think there seems to be benefiting a bit also because their Europe contribution is less vis-a-vis some of the others. So these cross-currency tailwinds would not be as adverse for them as for some of the others. So looks a good play. I would still prefer Mindtree in my mid cap and KPIT, but it continues to remain in our radar.
Gurmeet, hi, good morning. Gujarat Fluoro came, any views? Numbers came day before, but that big reaction, beg your pardon, on the downside came yesterday. Numbers are were very strong, but fear is that this may be the best. Any thoughts?
No, looks pretty good, Prashant. So if you see within this fluorination chemistry, you have 2-3 different players. In fact, you have to break it down further. So you have Gujarat Fluoro, which is more fluoropolymers, right, and which are used in as various intermediates. Then you have Naveen, which is more into fluorine intermediates, more in terms of APIs and CRAMS kind of an outlook. And then you have an SRF, which is more diversified. It's into textiles, packaging as well as and more focused on the refrigerant segment and the gases segment. So I think Gujarat Fluoro looks good. Then there is this specialty angle to it in terms of the EV related chemicals, and overall I think I'm very constructive on this space. So we like Deepak. We are monitoring Gujarat Fluoro. We also look at PI Industries. It's a combination of agro and custom synthesis.
Okay. All right. Gurmeet, just stay on. We have many more questions to ask you, but we have a management joining in as well. So I'd request you to listen into this. Home First Finance, it saw healthy business momentum in Q2 because of customer acquisitions being strong. Further, the company has seen margins expand, but interest expenses have also seen a sharp 17% sequential rise. Manoj Vishwanathan, who's the MD and CEO of Home First Finance Company, joins us now to talk about that. Manoj, good morning and greetings of the season to you and your team at Home First. Can you start a little bit by telling us about the customer acquisition itself? What is the outlook going forward, and how do you see the trend as far as the loan growth is concerned for the rest of the fiscal?
Customer acquisition is strong because demand for housing is fairly strong. Post-COVID, that momentum continues. The demand for housing. So our distribution is also expanding to kind of capture this momentum that is there in the market. So that is what it is.
You want to give us a loan growth target for the year, Manoj?
Target for the year, we are on track for a 30% growth.
Okay.
You can see, the quarter-on-quarter is also at about 7.5%.
Okay.
So on an annualized basis, 30%.
Okay, got that. All right, so 30% growth is what we're working with. One worry, so to call it, is your interest expenditure was higher than the interest income. So clearly the cost of borrowing has gone up. My question to you is, how much of this higher cost has been passed on? Point number one. And in turn, what would it mean for NIMs going ahead? Because the risk is to the downside. Go ahead.
That's right. We are passing on the cost increase as it is getting transmitted to us. So you can see that on a quarter-on-quarter basis, the spread is constant. So we had a spread of 5.8% last quarter, and we have maintained that spread of 5.8%. So we have so far transmitted about 25 basis points to customers, and that is the transmission that has taken place to us as well. So we have a completely floating rate book, so we should be able to pass on the increase to customers as it happens.
Manoj, what is the incremental loan yield for the quarter?
On new originations, we are clocking about 13.4%.
So you're a relatively smaller player, and the big bet that investors are taking is that you'll be able to continue to grow at 30-40% for many years to come without too much issue. But if interest rates continue to rise like this, how much more rate hikes can consumers take, and will there be demand at those levels? Will you have to go down the curve to get to that, as you just said, 30% loan growth target?
Right. I mean, if you see the affordable housing segment, I mean, the segment that we are operating in, it's a very large spectrum of interest rates where companies operate across that spectrum. So you have companies starting from say 10%, 11%, all the way up to 18 to 20%. So there are customers right across the spectrum. So we are fairly confident that 50 to 100 basis points of price changes will not impact the demand. And customers generally calibrate their own demand for the loan or their loan ticket size based on the interest rate. So a 1% change in interest rate would mean probably they have to borrow slightly lesser, but that would not really change their decision to purchase the house.
Okay, in fact, that's what real estate, realty guys also tell us. Of course, it's in their own interest, but they do tell us that when interest rates move, it doesn't really impact the buying decision of the home buyer. But I wanted to understand a little more about your margins. They expanded this time, but your interest expenses have also grown. So tell us, what is the ballpark margin that you can end the year with, the net interest margins?
We are passing on the rate increase to customers. So we are confident of maintaining the NIMs.
Around 6.5%?
That's right.
Okay, all right. Manoj, before we let you go, final question on asset quality. It's improved a little bit. Your net NPAs are at around 1.4%. Gross NPAs have come to around 1.9%. So what's the outlook on this front? And you joined us, I think a month or so ago, because there was the fear that Warburg, that has a large holding, close to 28%, the fear was that they will sell. You said at that point of time you haven't heard from them, and you believe that they're not looking to sell. Any other dialogue you've had with them, or you've not heard from them till now, and they will hold on to that big chunk?
No, absolutely. I think that was just a rumor, and there is no such plan to exit the company at all. So that is, I think last time also we went out and mentioned that. So that stays. I mean, that stand stays.
Okay.
That, they are here for the long haul.
Okay. Asset quality?
On the asset quality, things are, if you look at the collection efficiencies and, customer behavior, it's back to pre-COVID levels. There are a few customers who got impacted by COVID and because of the new RBI norms where we have to report them as NPA, that, small cluster of customers are still being classified as NPA. Otherwise, things are really back to normal.
Okay, all the best. Things are back to normal. I guess that's the moot point, right? Thanks a lot for joining in and giving us a view on the business. That's Home First Finance. Let's slip into a quick break. Up next, we will have our technical experts joining in. Mitesh Thakkar and Kush Bora will be with us to talk about some technical trades and how to plan the day.